Thanks everyone for joining us. This is recorded, so we will send this out if you miss any piece of it. And then the chat is open as well. So if you have questions along the way, throw those in there. And um, uh, Clayton Bailey, whichever one of y'all kind of want to man that chat, and we'll go through those at the end. So tonight we're going to talk about the Grove Victoria. You may have seen it in an email. This is kind of high level right here. It's 288 doors, 1982 built, multifamily. It's located in Victoria, Texas, 4405 Navarro for reference. For those from or not from Victoria, our corporate office is 4800 North Navarro. So literally kind of, I say directly across street, kind of catty corner. I'm just going through the OM, so it has the disclosures in there. This is all in the portal as well. Um,
Brian, sorry to
so,
interrupt. I can't see your OM.
Yeah, you're not casting the screen.
oh, I'm not casting the screen. Okay, sorry. Let me, I
I did see
apologize.
it, but it cut off.
Okay, all right. Well, how's that?
Perfect.
Okay. You see the disclosure?
Yes.
All right. Sorry, everyone. I'm not the best technical. So, all right. So here we are, Grove, Victoria. I'll kind of go back to page one. This is the one I was reading off of. 288 doors, 1982 build here in Victoria. Just general disclosures. Again, this is in the portal. Just some kind of high level property information and overviews. This is kind of your high level metrics based on a tier two investment. We'll dive into that a little bit deeper and some of the future pages. Overall about the property, 288 units built in 1982, 92% occupancy. That's when we contracted. We're actually tracking and going through that in due diligence now. Sits on 10 acres, current average market rent, $905, average unit size, 709 square feet. Some more in depth. I won't read all of this off. Again, you can see it in there, but this just tells you some additional details from parking spaces, what school district it's in, some of the fees and deposits that they're currently collecting, asphalt paving parking lot, copper wiring. So just a lot of details there. Some decent information. Their boiler system, it is a boiler system property, and those were replaced in 19, 21, and 23. So that's great. Those are all newer because those are some heavy expenses. Some of the work they've done, some hardy plank, painted the brick in the exterior in 24, just some of the update they've done. Again, we will dive into that a little bit more. Here's a floor plan mix. We're pretty excited about this, so I'll spend a little bit of time here. So we have multiple floor plan types, five different types here, quite a few, and we'll get into the mix of those, but in our market, there was, in your early 80s, lots of saturation from two bedroom, one baths, and we don't have a lot of those here. We do have some, but not a lot. One ones always do really well for us. Two twos do well, and then they have some three bedroom, two baths. But you'll see based on these are more of a, even if you kind of look at, and I don't know if y'all can see my cursor on the screen, but if you look at the 2-2 on here, it's set up more of a split bedroom plan. And you see that a little bit more nowadays, but you didn't see that in some of these, kind of early 80s vintage. So that's really nice. It just gives you more of the, the home feel. So we're pretty excited about the floor plan. Here's some of the general features they have now. It's got your standards, nice pool. It's got a barbecue area. They have 3 laundry facilities, which is great. Some of the interior features on their platinum units is granite. They've updated some appliances. They've added some washer and dryer connections. So pretty nice there. Some of this will be expanding. We don't think the community has the amenities for us to reposition this kind of like a B plus, maybe considered low A quality. We want to just add to those amenity features. There's not a dog park there, and with 288 people, you can only imagine with pets and walking in the grass what that can turn into. So we're going to add in a nice dog park, looking at expanding the fitness center, gating the complex. And again, we'll get into that a little bit more. High level. So we're purchasing this for 16.9 million. Recent CapEx and some recent years, about 3.8 million they've put into it. Our going in price is just shy of 59,000 a door, and we're projecting a 5-year hold period. We'll get into the business plan. So highly discounted acquisition, going in at that 16.95, 58,800 a door. So it's discounted by about 6.4 million. Clayton, will you admit everyone that's as they're popping in? I just noticed there's some people trying to get into the lobby, so if you'll just admit them. 3.8 million they put in capital improvements. 23.36 is owner invested. Actually, the total cost base I think is almost closer to 25 based on a few things I've looked at. So just almost $8 million discount here. It's a forced sell. There's a lot going on with the deal. They bought this back in 21, 22. They were new to real estate and multifamily in general. They bought it based on physical occupancy. They just didn't do really good due diligence on this. And unfortunately, after closing, they dropped down to about a 40% occupancy. The bank froze all their CapEx funds. So now they had, 160 vacant units and no money to turn them. They had floating rate debt that wasn't fixed. That started adjusting on them. They were having to buy down rates every year at renewal. So it was just a perfect storm of things happening. Plus, they were managing from afar. I actually got to know this group back in 22, and they asked us to come in and kind of help with the deal when they first started struggling. And we weren't able to make that work at the time. And just fast forward, and this is what's happened. So a lot of other things there, but they have until March to pay this off. But even currently, the interest payment has doubled. It's gone up about $75,000 a month. So it's just a monthly struggle. So they're pretty incentivized to get this closed, and we're picking it up for just pretty much the bank balance plus closing cost. So that's where just a deep discount going in on our basis. Overall strategy, we're going to renovate 260 units to the market standards and do a kind of a quality check refresh on their prior units. So they have updated some units, but still we'll go through them, just make sure they're up to our standards, and it's not going to be a make-ready maintenance repair nightmare. Amenities, we're going to install a dog park, fitness expansion, gated entrance, along with some other items. Kind of just correct a lot of the operational inefficiencies. Some decent staff on site. We've met, we will interview them, possibly bring in some of our own. So we'll just make sure that's being done properly. Occupancy, so we are factoring at the 24-month stabilization to be 88% economic occupancy. For comparison, our portfolio does around 93%. So we're 5% below what our current 1,000-unit portfolio does in this market. And that's at the 24-month stabilization, and we ramp up. We'll get into that a little bit more, and I'll have Clayton dive in there, what we ramp up from like low 70s to the 88 and how we do that. Going in, entry cap is 6.25 with 70% economic vacancy currently. And then we're looking at a 6.5 exit cap there on the 5-year hold, which is pretty on par with the market. It's about a 46% NOI increase over the 24 months. And again, we'll dive into financials. There's not huge rent increases necessarily. A lot of it, there's some just expense efficiencies and things that need to happen there. We're looking at debt. It's a 36-month initial loan, 7.4% interest. We're still working on finalizing that. We've had some pretty aggressive loan quotes come in, so that may actually get a little bit better for us. But the plan would be we're doing initial loan now, just with their current NOI. Agency debt's not really an option here, just with their economic and possibly even vacancy, could drop below the 90. So we'll go in and do more of a conventional loan there. We'll refi at the 3-year point after we stabilize, sometime after the 24-month point within year 3. And you'll see on the projections that returns most of the capital there. We'll cash flow for a few years and then exit in year 5. This is just a little bit more of the breakdown of the unit mixes. Kind of what I was talking about earlier. You can see the 2 1s here is about 48. So 48 of the 288 is a pretty small percentage. Really nice portion of the 1 1s, some 2 2s, and then you have 24 3 2s. So really good unit mix. You'll see their average rent, 807, that's factoring in some vacant units, and you'll see some of these are just really low. Current market, though, they're about 1,020 compared to about 1,139 stabilized. So it's not, like I said, not a huge lift on what we need to do if they were at current market and operating properly now. So this is kind of a breakdown of our capital improvement plan. We are actively working through bids between our construction team, some partners from Houston that came in. So we're getting bids. So this will probably adjust. This is how it's underwritten, but there could be a chance, some of these line items go up, go down, just not to exceed. But it's about 4.4 million we're looking to put into it. This just gives you an idea how we're breaking down the funds between all the units. You'll see like an A1 obviously has more funds because we need to turn all those units versus an A1P, which is their platinum, just has a little bit of a quality check, refresh there. And this will all happen between months 1 through 24 on the units. And then you'll see at the bottom between months 1 and 12, the 3 months, the 6 month, and kind of just gives a little projection how we plan on doing this. Obviously, the more dialed in, detailed plan just gives you a nice overview. So we'll get into the investment overview. So we do have 2 tiers. There's a tier 1 and a tier 2. Tier 1 being 100,000 minimal. Tier 2 is our 250,000 minimal. And we have both those in here along with projections. So this is a 506C. So for accredited investors, if anyone's watching this and not super familiar with that, always happy to hop on a call and talk through that. But there's a 506C. Total raise is a little over $6 million. For the 100,000 investment minimal, we're projecting 22.8 IRR to 2.25 equity multiple and average annual return of about 25%. We also include this sample investment at the bottom. This is always really neat to look at, especially on the 100,000 one because it's really simple math. But his projections are pretty low in year 1. You'll understand why a little bit more when we get into the financial breakdown, just because we project a very, not very, but I mean, pretty low economic occupancy in year 1. Definitely opportunity for that to improve, but we like to be conservative on that. We get some good cash flow in year 2, obviously a nice refi and return of most capital in year 3. And then you can see the future years. This is a 8% pref is factored in here. So the 8% pref is the first hurdle. So that'll be paid first to all investors at an 8% coupon rate there. And then this is a 70-30 split thereafter on the 100,000. So tier 2, a lot of similarities there. It's just some little bit higher returns because it's 8% pref, same coupon rate, but it goes to an 80-20. Just a little bit better returns there for the larger checks or larger investments. And then we have the same sample there at the bottom you can look at. So as we dive into kind of financials there, Clayton, you want to kind of take this for a few minutes and just tell me when to go through slides and just kind of talk about what we're looking at here?
Yeah, sure. So first page here is just generic operating income. So we have our revenue section at the top and expense section at the bottom. A big note here, the really only major change we have in year 1 and 2 during stabilization is getting those existing units up to where markets are and then pushing them slightly once we start digging into the property. And with that change, there's not really a massive shift in expenses. And as Brian mentioned earlier, the model does kind of look abnormal when you say we're going to increase, income by, 46%, and then, expense ratio is going to stay the same or go down. But operationally, they're a tad bit overstaffed. They're spending a lot of money on advertising these units that we know we can do better in the market. So overall, the expense shift isn't really happening at all for the first 2 years. We think we can bring it in, stabilize, and actually cut some of the categories quite a bit. So essentially, here we have our 5 years across the top. This is just operational income. You'll see during year 1 and 2, those vacancy and market loss concession lines go from really large numbers to really small numbers into year 3, where they're essentially not going to shift a whole lot after that. That's just that stabilization period happening. Go to the next page. This page is just all the CapEx expenses. Of course, we broke it down the CapEx on the previous page. So this is taking our NOI minus CapEx of $4 million. And then it shows the different loan terms we have in place. So we do have some, initial debt going into the deal during the construction period while we're stabilizing. And then by year 3, we're going to maximize that revenue growth we've created and exit, at I believe it's a 73% LTV, and come out of that and pay a decent chunk of that refi proceeds out to the investors. So you'll see that coming down from loan 1 is the initial bridge, loan 2 with the refi. And then we'll go through and you can see we have a cost tag, some tax prep fees yearly. And that comes down and tells you, your cash flow after debt and all asset management, as well as your DSCR. So you can see those DSCR numbers are pretty aggressive, even after the refi. Banks are looking for the 1.25. You can see as we come into year 3, we're already at 1.73. So plenty of room for the refi. And you'll see a little bit later in the risk analysis, it's very, very conservatively underwritten. Next page. This is just closing out capital events. So the actual exit, the entrance and the exit of the asset. So any fees associated with that, along with the expected sales price of $35 million. You can see there in year 5, there is a $2 million deduction there. That's for, fees, closing costs, those sort of things from brokers. And you kind of see how the cash flow processes through each of the waterfall hurdles. So again, Brian mentioned hurdle one being preferred return, hurdle two being return of capital, hurdle three being split cash flow. Now the page you're seeing here is related to tier one investments. So this is showing you basically the lower investment tier. If someone wanted to know the specific waterfall numbers from, tier two, I'm happy to provide them. But you can just see how it's paying down that preferred return. And again, in year three, that return of capital being nearly 100% paid back to all investors is a major win on any deal, I think. And then, of course, you can see how that also funnels through with the exit as well. Next. You want to take this, Brian?
Yeah, I can. And then one thing, touching on the refi, just try to think of things that I've been asked as I've been talking to a few people about it. The value, it's about a $24 million loan at the year three. We talked about the going in's about 58, little under 59,000 a door. We currently have other assets in the market stabilized that, we're stabilized around 90,000 a door. And so you take the 288, the 90,000. So even what we're projecting on a year three value is not far cry from what it would be worth today, or arguably is worth today if you just get their NOI in line with where it should be. So just a note there. So this is something we spent a lot of time in. Clayton's put a lot of work in. And just for that kind of perspective here, every one of these scenarios requires a new model to kind of be underwritten. So you can imagine how many models were worked through. So it's a lot of very time intensive. It's something we spend a lot of time on and we value a lot. But what we've done here is, the as modeled is obviously as it's modeled. Again, this is off the tier one investment. We do a worst case, we do a best case, we do a break even. Someone said, "Oh, that's the worst that could possibly happen." No, I mean, obviously, I guess things could get worse. It could go to 0% occupancy, and we just didn't lease it at all. But pretty worst case scenario for that the worst we could possibly see it getting, and even this I think is a far cry. And then best is if some things get better. So what you'll see is, like revenue growth, we're saying, okay, if there was no revenue growth, what if expenses went to 5? What if the exit cap rate, just grew to 7.5, economic occupancy dropped to 85. So that's what all these scenarios are, something to look at more in depth. What happens if we get lower proceeds? You'll see some things make the equity multiple worse. There's certain things that make the equity multiple better because if we refied less, you pay less interest, can make a better multiple, but then it lowers your IRR. And then the bottom is the range of what could happen, what those metrics could change to, and it's just an average of all those. Similar, if you jump over to the best case, it's what happens individually. So for instance, if expenses rose, if rent growth rose to 6%, then it goes up to a 2.84. If expense growth alone, you went to 0, you're a 2 point, so it's just showing what happens in those individual cases and an average. Now the break even point, and this is something we added in recently because, people say, okay, what does it take because you'll see even our worst case you don't get down to a break even. So we modeled it out and said, okay, what has to happen for this it's a return of capital. We didn't lose, we didn't make anything, it just returned. And this is kind of collectively, all these things need to happen. So in this perfect storm, we need to see a less than 1% revenue growth. We need to see a 4.5% expense growth, 7.5% cap rate, 85% economic occupancy, interest rate go up to 8.4 on the initial loan, the refi rate go to 7% and a 65% LTV. And some of those are controllable now. If the initial rate went up, we already have that locked. We're virtually locked in. So some of this can't even happen, but it's just, these are all the things that need to happen to get you to a break even point. So a lot of time, I definitely recommend everybody spending some time on that, and then always ask questions if you have them. Kind of talk about the area a little bit here. Just Victoria for those that aren't local, and I won't go in depth in these pages, but there's some great data in there. I would definitely recommend looking at it if you want to know a little bit more about Victoria. So we're the crossroads, 2 hours from Houston, 2 hours from San Antonio, 2 hours from Austin, about an hour and a half from Corpus. So always been referred to as the crossroad. You see on the map there. And again, I won't go through all of these, but there's just a lot of different data in here about the area. Some of the drivers here, Victoria, we have a lot of the smaller towns around us. There's a lot of plants, and you'll see a lot of that's referenced here. They're in smaller towns. There's not a lot of housing. So a lot of I'd say majority of The employees at these plants are housed somewhere in Victoria. So you see the metric there, over 91,000, you're just in the 7-county kind of radius there. So, but a lot of data there. The colleges, the hospitals are a big piece. This still references University of Houston. That's SIT's transition to Texas A&M. We're really excited about that. We became there, I believe it's the 12th campus for A&M. So there's already a lot of great things happening there. This is just kind of where we're located. You'll see the Grove just very centrally located. One of my favorite factors probably about the Grove, even compared to some of our other assets, is just so centrally located off 2 main thoroughfares, Navarro and Mockingbird. And you'll see we highlight where our corporate office is there. So great location. A little bit about us for anyone on the call or that's going to be listening that doesn't know us. This is just a little bit about information about me, us. We've been in the business 20 years. We started out in single family, started growing our portfolio. We currently have a little over 1,000 units, 500,000 square feet of retail, primarily Victoria, Texas, and then we're also in the Katy and Sugar Land market as far as our retail space. This is our kind of our leadership team here. A few of which are on the call today. Clayton, who's VP of Product Development, does all our underwriting and modeling. You have Bailey on the call, and I didn't introduce anybody in the beginning, so I apologize for that. I'm a little late on introductions. Bailey is Director of Asset Management, also oversees all property management, and then there's some of our other teams. So you'll see we have this is not our whole team, just kind of high-level leadership team and everyone that's overseeing the day-to-day there. So this is just a little bit more about us. This is us, Bailey, if you want to just kind of chop in here and talk about just some of our different assets there, high level, and then maybe, even though we're not on that page anymore, just maybe give a little bit more color to the takeover, the plan, and maybe what we're doing now on the current one and how that'll relate to the Grove and whatever else you think.
Yeah, so overall, you can see on this page that it kind of highlights who we are locally and our footprint inside of the Victoria market. So you can see here that, like Brian had mentioned before, we have about 1,000 doors locally, kind of spread out through the local market, with the Grove being centrally located in between those assets. So our assets range all across the Victoria County. So we've kind of built our overall kind of experience inside this market and know it well. In relation to the Grove, I mean, we highlighted a little bit about kind of our floor plan types, what we're looking at there. But overall, kind of plans for the property is that we're currently in due diligence. So we've walked every unit, evaluated full exterior using both in-house as we're vertically integrated and outside vendors to ensure that we have multiple kind of bids on the current project. Our goal is to take all units and either upgrade them or go through the quality check, as you had mentioned. We have about 28 upgraded units across the portfolio or across the asset, and we're looking to upgrade the rest of them to kind of get that market increase that you were discussing. In regard to exterior, like you said, we're expanding kind of amenities across the asset, in addition to the dog park, fitness center, and then gating it. In addition to that, we are looking to really just do overall kind of quality control. You had mentioned that there was multiple struggles about what we were kind of going in and correcting from previous ownership, and a lot of that is quality of the project and the work that was previously done. So we're looking at rotten wood, exterior paint, parking lot repairs, anything from foundation to how can we ensure that the tenants are having the best experience. I think one of the best things that kind of ties back to our local footprint is just our ability to know our market and know it well, but also the options that we have to cross-sell. So a lot of the times, with how wide our footprint is in Victoria, we have the ability to kind of pivot in the market and decide where we're going to place tenants because of the assets that we own. So one thing that I really love about this community is we have 168 one bedroom, one bathrooms, and in our entire portfolio, that is the largest one bedroom, one bathroom footprint that we'll be adding. In addition to that, the 24 3-bedroom, 2 bathrooms that are here. So I'm excited to be able to offer that, even as our current tenants kind of upgrade from smaller assets to larger, as this is going to be our largest one. The team is really excited about the ability to be able to kind of pivot that and place them here. So I think it's gonna be great.
Awesome. Yeah, and just the dots are literally that those are accurate. So every dot is one of our assets. To the point, like one of the directly behind it, you'll see there is one of our strip centers. We actually have an extra, I don't know, quarter or half acre, and we're going to be able to
Mhm.
utilize that to create the dog park for the property. So, um, and it's actually the only building that really surrounds it. You're surrounded by streets, and then for the most part, and then our building. So those are all ours. So you can see we have a very good foothold here. This is our just a deal history. Some of it's active, some of it's stuff we've done. So you'll see just, about 350 million exit valuations. I think that's growth, probably closer to 500 now since we've updated this, just as we're still very active in single family and different things. So this is just a mixture of larger assets we own, some developments we've done. You'll see we're pretty well versed there. This is a little bit about us too. I'd like to point this out. You'll see if I say the color wrong, I am actually colorblind. But the bluish purple line there is, so that is, you'll see that's our kind of assets owned directly. And then the other ones are total assets under management. And then the one at the bottom is syndicated. So from kind of that 2000, we started in 2005, probably '07 before we actually started holding assets. And that grew to about 90 million. And so about 20 million of our 110 is syndicated. The other 90 is not. So I think that's an important thing to note. We did not start taking anyone's outside capital until we truly knew what we were doing and had a track record of doing it. And so we do like to highlight that. A little before and after, this is a deal we bought a few years ago. Top is a before, the bottom is an after. So we've executed this same game plan many, many, many times. Here's kind of the process. So you can review the offering, you can log into the portal. If you're not logged into the portal, you can just go in there, create an account. Once we have, activated that, you'll be able to see this offering and the other ones. It's pretty simple. You go in, the portal allows you to reserve, if you said, okay, I want to reserve 250,000 bucks, it'll take you, you complete your paperwork. This is for accredited investors. Like I said, if someone needs help on that, I'm always happy to do that. But our system does offer a way. It's no charge to you where you can get your accreditation through there. And once you have that, you literally set up your account information and you fund the investment. You can also submit accreditation from, there's a few other ways you can do that. Your CPA attorney, they can write you a letter. Again, we can help guide through that process. So pretty simple. The portal's kind of is your go-to. You can see what kind of returns you're making on it. That's where you'll see a history of all your returns, copies of all your documents. You'll get notifications anytime your distributions happen, which is, so we update quarterly. So let's say Q4 ends in December. So about the fourth week of January, you'll get an update from us, outlines kind of what's going on with the project, where we are, tell you if the distribution is, kind of tells you what you're tracking percentage-wise of distribution. And then we process that distribution. It takes 3 to 5 business days, and then those end up in your account. So again, can always clarify a little bit more there. Our investment timeline. So we're currently under contract, and then we're completing the due diligence, and we're projecting a January closing. If due diligence went well enough, I've had a few people ask, could it possibly close in 2025? It is possible. Is all the capital in place, and are we through all the due diligence? Kind of update on that. We've been on site. We're just waiting on lease audits. They're missing quite a few leases. I think it's 100+ leases we're missing. I think it was 117 I saw earlier today in an email. So we're working on getting that done and then getting bids and finalizing all that. So we'll probably be extending the due diligence period a little bit if I had to guess, unless they can just really turn that stuff over fast. And with the holiday, we'll see. But is it possible to close this year? It is. I really think it's gonna be closer to January. And then as far as we're about 2 million of the 6 committed. A little over 1 is from us. We're putting in. We may put in a little bit more, actually. Just depends on some things that may be closing on our side, and then just some other commitments. So we're about two-ish, and growing on the commitments. There's plenty left, about 4 million left. So, and then again, this is just the last piece of the packet there. But yeah, if anyone has any questions, this will be recorded. We'll send it out. If you have questions, here's email, website. It's literally my cell phone right there. Call, text, whatever works for everyone. And if you're new and you're watching this, definitely encourage reaching out. Let's hop on a call, get to know each other, grab coffee if you're local, whatever that may be. So that being said, let's see. I don't see we have any questions in the chat. So if anybody has any and wants to, kind of throw some questions in there, please feel free to do so. But okay. Bailey, Clayton, anything else you kind of want to add that maybe I missed?
No,
No?
not
Okay.
that I can think of. Let me give people a minute or so to put in questions if they have any.
Yeah, I mean, just overall, I mean, it's, and I say this a lot, the returns projections are great on here. I've had people ask, how are the projections so great? How are they so high? It's, yes, we're going to execute a value add plan. Yes, we're going to put granite and turn units, the standard things, but the going in basis is there. You got a $90,000 door complex. We're buying sub 60. It's an unfortunate situation. It's a distressed situation, but, we're helping them. We're trying to prevent it from going back to the bank, which is definitely helpful on their side to prevent the foreclosure and, partner with some other folks and reap the benefits of that. So, how is competing with yourself since you own a lot? Okay, so love this one. So a little bit about Victoria on, when you hear A class, B class, C class, what clarifies those depends on who you ask. That's my honest opinion of it. There's not a definition. There is, but I don't think it's like in stone. So Victoria is an interesting market. We had a lot of units come online early 80s, late 70s, and then again in 2014. Virtually nothing in between, maybe one that wasn't some type of workforce housing. So if you want a nice B plus class or even lower A class, something that would be built late 90s, early 2000, the way to do that is to find a well-located, well-constructed early 80s vintage and repurpose it. And that's exactly what this is. One of the best locations. We own some 1980s that we've done that with. So we're still probably, we're still in a unit count to where I don't think we're competing with I don't think we're competing with ourselves. So if you take, for instance, the post that we just closed on was formerly Tanglewood. That's going to be, we're getting into the B class realm, but it has C class next door to it. There's nothing we can do about that. We can increase our rates, but this is a step above, I would think that, and we're definitely kind of we're below some of the A class, so you take the 3.2s, $14.99 is our 24-month projection. We're probably slightly lower than that other complexes. You get to the A class, they're going to be in the 16, 18, 1900 range. So we're servicing that in-between model, which is helpful. So no, I'm not really concerned with us competing with ourselves there, because it actually offers a little bit of a product we don't have. We have a property at the Villas, there's 134 doors. About 80 of those were 80s class, and the rest is 2014. But probably the biggest competition would be that, and we literally have a waiting list. Our increases, we do multiple increases throughout the year. We're able to do it just because it just fills up. A good example, the early 80s stuff does better for us than the 2014 half of it, because it's a split build vintage there. So we're really comparing to that. I wouldn't say our market comps are as high as what we have at the Villas, but just from a conservative level. But I kind of hope that answers that. So no, we're not overly concerned there. Now, do I think we'd go add another 1,000 units here in Victoria after this acquisition? No, probably not. There probably is a point where it could be kind of an issue on competition. On exit, who do you expect interested in buying the property? So spent a lot of time on this recently. If you pull, and this answer is different if I was selling a 100 unit versus a 288. It's another exciting factor of this. The 288, when you go to exit this and you're in the, a $30 million property, let's say, it's going to appeal to a lot larger buyer pool. And so current ownership throughout Victoria, there's not a lot of local ownership. I'm not saying there's not any, but most of your larger complexes, take a handful amount, everything is owned. It's out-of-state buyers. We have New York, we have California. Actually plan on putting a list of that together, and we've been talking through that. But I think we'll appear to just, some larger groups, some groups that own assets, in town now, just from out of state, like I said, because most of ours is out of state. We get some Houston buyers and some interest there, maybe some of your larger markets within a 2 to 5 hour radius of us, but there's quite a bit of out of state. And so we would take this with a national brokerage, a Newmark, a Marcus and Millichap, something like that, and have them market it at a national level would be our exit plan there. And important to note, we talk about the average cash on cash, just something someone asked me earlier today. If you took the sell out, I think the cash on cash in year 5 is somewhere between 12, 14%. I don't know, Clayton, if you remember off the top of your head. If not, no worries. But Cash on cash is great in year 5. So worst case, it takes a little bit longer to sell. It would be cash flowing really nice with really healthy distributions. Okay.
Yeah, I was gonna say we're okay. Yeah, you're just over 10% already, and when you're going in that refi period, so yeah, it's real decent. Even if it takes a few extra months, I think it doesn't really have a major impact.
Yeah, double digit cash flow there, so it's really nice. And it's important to note at 36 months, I mean, most of the capital has been returned. So, okay. All right. All right. I do not see any other questions in there. Again, we will send this out. It's in the portal. It is live. Happy to hop on a phone call with anyone that's interested. So I appreciate everyone who did take the time to kind of spend with us this evening, and we'll let everyone get to it this evening, and we'll get this sent out soon. Thanks, everyone.
Thank you.